Hey, what's up, everybody? It's Justin Atterbury. It's your favorite hometown lender. I hope you're having a wonderful start to your Tuesday here. I know it's gorgeous outside, and I got to go have coffee with a couple of friends of mine this morning. That was really nice. We got to talk about just some strategies on how to help you guys out in this market. In fact, these two friends of mine, they're not just friends, but they're also realtors that I have the privilege of working with. And it's one of the things that we always are trying to do is market in a way and be proactive in ways that are going to do nothing but benefit you guys as you're out there searching for homes. But what I want to do today is take a little bit of a detour away from the home purchase side of things. And believe me, we've got a lot of stuff in store for you guys that's going to continue to help you out there. But this is going to be directed for those of you that are looking at potentially refinance. Okay. And these are ways to help you as current homeowners looking to refinance, how you can leverage the equity that's in your home to your benefit. So I've got a couple scenarios pulled up here, and what I'm going to do, just like I always do, is just kind of share my screen here so you can see what I'm talking about. So the first thing that we're going to do here is we're going to look at this screen here. Okay, so what I've done is I've kind of created a scenario, and it is a mostly made up scenario, but it's kind of like a Hollywood movie. It's based on a true story. Okay, so not all the facts are in here, and I do that on purpose to protect the identity of individuals that I do work with. Okay, so these are similar scenarios. Now, just kind of going down the line here so we can make sense of this. So this is someone whose current property value is $380,000. That's going to be across the board here. Okay, what they currently owe is $250,000. And then each of these are just kind of, so you'll see here, this $25,000 cash out option. But what they currently have is they have a 4.25% interest rate. Okay, that's what they currently have. So anyone with a 4.25, a 3.875 or higher interest rate, you really should be looking at options of doing a refinance. Now, whether that's what we call rate and terms, let's just drop in the interest rate, maybe even drop in the term. So 30-year to a 20-year, or 20-year to a 15-year, or a 30-year to a 15-year term. Okay, rate and term. Okay, sometimes we might refer that to as rate or term. But what they have is a 4.25. Okay, now the payment is not actually 28 here. I'm going to help you make sense of this. Their current payment is right here, 18.10 and 31 cents per month. That is principal, interest, taxes, and insurance. Okay, so one of the options that we looked at here was a restarting the clock. Okay, so they've only been in the house for about 3 years. Okay, and they wanted to look at a 30-year option. Okay, and what that would do is just drop in the interest rate. That's going to give them a new payment. Okay, so the interest rate in this case was 3.125%. And you can see that right here. Here, I'll kind of jump off here. So 3.125. All right. And that's going to give them a payment of $16.94. So what that does is it's going to save them about $115 a month. Okay. So nothing overly significant. It does restart the clock. So it's a 30-year term. They've been in the house for 3 years. That's going to restart the clock for a new 30-year term, but they're going to also save $115 a month. And so one thing I always kind of go with everyone that I do a refinance for is say, hey, look, you're already used to making this payment of $18.10. What if you just kept making that same payment? Okay, so saving $115 a month, and they just keep making that payment of $18.10. Basically, what that's going to do is that's going to take that 30-year term. Excuse me, I'm sorry about that. It's going to take that 30-year term, and it's going to drop it to just over 25 and a half years. So you start with 30 years on a 3.125% rate, keep making the same exact payment that you've already become accustomed to, and then you actually pay this off in a little over 25 and a half years. Okay, so you're going to gain back. See, if you see here, 26.83 years. Okay, that's how long they have left remaining on the current term from when they bought the house. They're going to get back about a year. Okay, it's going to save them 12, 13 mortgage payments. Okay, not a bad gig at all. All right, now another option we looked at is they said, well, what does a 15-year option look like for me? So I worked that up for them. And let me kind of click off of these right quick. Okay. So what that does is I'll leave that one there. I'll leave this here and that. But on a 15-year term, again, the property value is still $380,000. Once you roll in your closing costs, looking at $256,599. Okay, but with that, on a 15-year term, and most of you probably know this, but a 15-year term does yield a lower interest rate than the 30-year term and the 20-year term. Okay, so 2.5 interest rate, 2.582 on the APR. Just so you know, the mortgage payment's always off the interest rate, not the APR. APR is just your interest rate plus whatever your closing costs are. When you put those together, it's expressed as a percentage. That's all APR is, annual percentage rate. Okay. But what this will do is it will take their payment to 2305, almost 2306. Okay. So they're going from 26 years, almost 27 years remaining, dropping that down to a 15-year term. So their payment's going to go up quite a bit. Okay, I think it goes up about $400 or $500 here. All right, so that's a bit of a hefty increase in the payment. And they said, "Oh, yeah, that's more than I was thinking," which I get that quite a bit because we all know rates are really low and they're even lower on a 15-year term. But what you have to keep in mind is that, again, they're going from 26, almost 27 years remaining down to 15 years. When you take that many months away from a mortgage payment, that's going to increase the payment more than most of us kind of think will happen. All right. But again, it's why it's always good to look at it so we can set, I want to say reality, but just kind of let you know what that payment will look like. Now, the next option was something that they weren't really considering at first. But then as I kind of walked them through how to get this down to a 15-year, their eyes kind of opened up and their ears perked up, if you will. And there's like, oh, this is interesting. Okay. And that's kind of what I really want to go over with you today. All right. So what they did is they had about $25,000 in other liabilities. In fact, one was a credit card, another one was an installment loan where they had consolidated some other debt years ago into just one of those consolidation programs. Okay, and so let me show that to you. So I got to stop sharing the screen and I got to come over here to this one. Okay, and what it is right here. So you see that they have about $250,000 left on their current mortgage. They've got $13,000 on this credit card. Okay, and that payment is $360 a month. Yours may be different, maybe a little more, maybe a little bit less. Okay, and everyone's situation is always different. Okay, that's why, again, we want to look at these to see if this even makes sense. It may not, but more times than not, it does make sense. Okay, and then they had this, and again, for the sake of protecting information, of course, I just put ABC credit card company here, that's CC, and XYZ company for that consolidation program that they had done. Okay, but they had $12,000. That was a higher rate. I think it was something like 8.5%, which is fairly normal for those consolidation programs. But that was costing them $630 a month. Okay, because the usual consolidation programs is trying to pay all that debt off in 5 years. Okay, so run them $630 a month, and so that's running them quite a bit every single month. Looks like it's running them right at just those two debts alone of $990 every single month towards a credit card and a consolidation program. Okay. So one more time, back over to the other screen so we can continue to make sense of this. So that was $25,000, right? $13,000 on the credit card, $12,000 on the consolidation program. So they said, what if we wrap that in? Well, they have the equity, and this is how you can leverage your equity in your home to move you towards financial freedom. Okay. So what we did is we worked up an option here to where they were actually going to save $607 a month. Okay. So you can see that the payment, just the, well, this actually includes a little bit extra here, but the payment here, $21.92. So they're wrapping in $25,000 of other liabilities into their mortgage, because right now, while interest rates are nice and pretty, mortgage rates or equity money is the cheapest money on any market. I've been doing this 15 years, never seen interest rates lower than on a mortgage. Okay. So what that does is that takes their mortgage payment from 1810, okay, click off of those, 1810 to 2192. But we got to keep in mind, this is what 2800 came into play. So this 2830 here, that's their mortgage payment plus the cost each month of that $990. Okay, so that gives them a payment of 2830 every single month that they were doing on their mortgage, on the credit card, and on that consolidation. So now we're taking that down to $21.92 per month. Okay, that's saving them $607 every single month. And I said, well, what if, and you don't have to do this, but again, what if you took that, cut that savings in half? You take $303 and you put that onto your, add it to your mortgage payment every single month. Okay. In fact, I'll do this right quick. That's where this $24.95 comes from. Okay. I round up at this point and call it $24.96. So they're going to take $303 and they're going to throw that into their mortgage payment every single month. And what that ends up doing, we call this reinvestment. Okay. $303 every single month. They are going to pay off their mortgage entirely in 15.83 years. So a little bit closer to 16 years. Now they could actually pay more into this and get that down to 15 years, but I just cut it in half. All right, that savings. So you keep putting $300 into your savings account every single month, take the other 300, throw that onto your mortgage, and you'll pay this off in 15.83 years. All right. So this is one way that we're able to help you guys leverage the equity that you've built up in your home to put you onto that path to financial freedom. Now, if you have any questions over this, feel free to reach out to me. You know how to get a hold of me, and I'll put all my contact information in here. I love you all. Thank you for your time. Take care.